action in gold right now is not in the futures market. The futures market is dead in the water. Open interest is not changing much, and we have a very rare instance of open interest rising slightly. Actually, the most I think it has ever risen on a triple-digit move like this, down $110 or whatever it was yesterday. We are on a ship. The waves are getting intense. The lighthouse is not moving. It's the dollar that's having a malarial fever of hot and cold and hot and cold. And in the end, it will sink to the bottom of the ocean. Since paper cannot survive at the bottom of an ocean, it will just disintegrate, and that'll be the end of it.
In today's news recap, gold slightly recovers from over 1 week low. Gold recovered on Tuesday on bargain hunting after prices dropped to a more than 1 week low in the previous session as a temporary U.S.-China truce in reciprocal tariffs lifted appetite for riskier assets and dented bullion's safe haven appeal. U.S. gold futures were up 0.9% to $3,255. After 2 days of negotiations in Geneva, U.S. and China announced tariff reductions for the next 3 months, with U.S. tariffs on Chinese imports dropping from 145% to 30%, and Chinese duties on U.S. imports falling to 10% from 180%, 125%, leading to a surge in global shares. The U.S. and China had imposed tit-for-tat tariffs on each other last month, triggering a trade war. There is some value buying happening on gold at current levels, which is helping to prop up the price despite the generally better outlook for global growth with the U.S. and China on better terms, said KCM Trade Chief Market Analyst Tim Waterer. The consolidation move in the dollar has allowed the gold price to make a mild push higher. Federal Reserve Governor Adriana Kugler said the pause on import levies reduces chances that the U.S. central bank will need to lower interest rates in response to an economic slowdown. Now we'll show you the best clips of the latest interview. Don't forget to like, subscribe, and turn on notifications so you do not miss out our daily recaps. And check goldsilverstacks.com to get your Stacker's Handbook, the ultimate guide to stack gold and silver, packed with strategies to trade the gold-silver ratio and get more ounces and build wealth over time so you don't have to rely on market commentators to make your investment decisions. Enjoy the episode.
I've ever produced on AI. And I don't really produce much tables on AI because, frankly, I hate AI. But it's a good shortcut. I can't avoid it completely. Just like I can't avoid any technological innovation completely. I have running water. I have a computer. I live in a house. There's a fan on my ceiling. All those other kinds of things. I asked not ChatGPT. I asked Grok the question, or really I demanded of Grok. Show me the top 10 gold down moves from the last 10 years and the corresponding move in open interest on those days. So it showed me this. I have the top 10 moves down, the daily price drop in dollars, that on almost all of these days, except for 2, that's 80% of these days, open interest went down on that day. Now, Grok gives me some nice notes. You can see here, for example, the note on September 17, 2008, financial crisis. Margin calls led to liquidations. Open interest likely dropped. Doesn't have the direct data, but because of estimated data and other surrounding information, Grok is estimating that open interest dropped on this day. If you want to comment below and you have the raw data, please send it in. And yeah, if we can compile it in the comments, I'll make another video of the raw data so this can be more accurate. But I think this is basically accurate still. So we have November 12th, 2008, continued price volatility, deleveraging, reduced open interest. These are moves of 85 down, 70 down in dollars in gold. Open interest liquidating because people need to raise dollars. Shorts need to raise dollars so they cover, so they have their dollars back, and so they can use them for other margin calls. Now, you have these other moves, April 15th, 2013, that's the biggest move in gold of $140 down, taper tantrums, ETF outflows, and liquidation slashed open interest. The only 2 exceptions to these are August 11th, 2011 and August 11th, 2020, when open interest was up $2,000 contracts on August 11th, 2011, and up 1,500 contracts on August 11th, 2020. Now, what does that mean? What it means is that new longs are opening up positions on the dip. There is buying on weakness here. It means that new bets are being made that gold will go even higher. But it also means that existing longs are not selling on the dump. They're not panicking out. So what I think this is a major bullish signal coupled by what you'll see in the screens that follow, that gold is pretty much done falling, maybe a few days left, but we're not going to fall much in price from here. This is yesterday's table from the CME. What you see here is the closing open interest of 441,429 contracts, which you'll see in the next slide, is still very low, but it's a change, a positive change of 3,158 contracts. Now, if you look down this entire line over here where it says change, and you zoom in on this chart, it shows that open interest was up in every expiration on the gold futures market. There was heavy buying in spot, which had a change of 623 contracts at spot. That means you have to accept delivery of it randomly if your number is called. That means if you're buying spot contract, you are risking delivery of physical gold, at least a warrant for one specific 100-ounce bar. See, in July, we went up 1,181 contracts. In August, we went up 19,742 contracts. In September and October and November and December and February and April and August 2026. We were only down 2 contracts in June 2026. Other than that, we were up in every single expiration. That means there's a lot of longs that are betting on gold here, going out way into the future. These are very bullish bets. You see here the change of 3,158, and then you can see all of these numbers all going up except for the active contract of July, which was down 21,188. Despite that huge fall in open interest in July, all of these other increases made up for it and then some by 3,158 contracts. And if we move back to here on a regular zoom, remember that number 3,158, that is more than the increase on August 11th, 2011 and August 11th, 2020, when both had plunges in the gold price similar to what we saw. Yes.
In today's news recap, UBS buy silver now before it soars. Investors have a closing window of opportunity to snag silver around $30 per ounce before prices soar to $38 by the end of 2025, says UBS. The bank attributed silver's recent pullback to a risk-off market spasm following Trump's blanket tariff rollout and the resulting stock market slump. On a macro level, upcoming interest rate cuts and a sliding dollar support higher silver prices. Analysts also point to robust demand and a tightening supply for boosting the shiny metal's luster. Throughout 2024, silver kept pace with gold as both metals provided similar yields. This trend continued into the first quarter of 2024 with the shiny metal posting an 18% gain and the yellow metal rising 19%. That performance parity ended abruptly following the Liberation Day tariff announcements. After April 2nd, both metals pulled back from recent highs before starting their swift recoveries. However, these rebound trajectories have differed sharply. While gold went on to reach multiple new all-time highs, silver has struggled to break through the long-standing $35 technical resistance level, despite a respectable initial recovery. UBS analysts blame a rise in risk-off investor sentiment for the recent slip in silver prices. The uncertainty, volatility, and chaos caused by a global trade war are driving capital out of the stock market and other dollar-backed assets. Despite offering protection from inflation, silver got swept up into this widespread sell-off, although not for long. Now we'll show you the best clips of the latest interview, but first, smash the subscribe button, turn on notifications, and check our new Numismatics Handbook. Most stackers want to get active, but swapping their metals for dollars isn't an option. There's plenty of opportunities in the overlooked numismatics world. Mastering U.S. coins, key dates, and errors pays off by multiplying your ounces and capitalizing where others aren't paying attention.
If we move to a slightly broader view of the last 6 months, we can see the interplay of the gold price versus open interest, especially open interest lately over the last 6 or so weeks. What you can see here is that the price is moving from about 2750 to now just above 3200. I think it's 3250 now. And as this increase in price has proceeded from late January, we have seen a corresponding fall of open interest in the amount of contracts open in the gold futures market from 600,000 to about 440,000 now. That is a huge fall in open interest, concurrent with a rise in the gold price. That means, in the most basic of terms, if positions are closing and the price is rising, that means a short squeeze. It doesn't mean that everyone who's buying back a short is buying because he's being squeezed, but it means that the trend since late January is short squeeze in gold. It's not major, but it is happening, and it is being sustained for the last 4 months. Especially what I wanted to point out here is the last 6 weeks, from about mid-April, early to mid-April to now. Open interest has not moved much at all. It is pretty much stable at around 440,000 contracts. This says 438,000. This is a day behind. And what I was saying earlier in the introduction to this video is that the action in gold right now is not happening in the futures market. We can know this because despite the enormous price changes, the daily swings in the gold price, open interest is not moving much at all. If open interest is not moving much at all, despite the huge changes in the gold price, then it is not the futures market that is moving the gold price right now. That is what Daniel Oliver's point was when he said the factors that are moving the gold price now are much different than they were in 2008, 2011, when it was mainly speculators from the US who operate on margin. Now it is sovereign wealth funds and central banks, and those that do not operate on margins, they don't get margin calls. Just to note what is happening in the COMEX, while not much action is happening in the futures market, there's a lot happening in the physical stocks at the COMEX, in the vaults. We can see here that the gold supplies in New York have reversed from about 45 million ounces to now 39 million. That is about 6 million ounces in like 4 weeks or so. You can see from here, this is the sharpest decline in gold supplies that has pretty much ever happened in the COMEX in terms of rate. I'm not saying it means much just yet, but it is happening. And what is curious is that it's not happening in silver. You can see the silver supplies continue to rise. They stopped for very briefly for a few days, and then now they continue to rise. They're up at 504.72 ounces. Sorry, 504.72 million ounces, an all-time record high. Silver flows have not reversed back out from New York yet. So something different is happening in gold than silver, which is reflective in the fact that the metals are not trading together as they usually do. Going up and down, you just need some perspective. It's the dollar that's shaking, and it's gold that is steady. Why is the dollar shaking? Because one day there's triple-digit tariffs on China. The next day we're working out a deal and we're all friends again. That changes the flows of goods and services and trade throughout the world and affects everything. And because the dollar is the reserve currency of all other currencies, it's the dollar that gets affected the most, and thereby everything down the line. And because the dollar is the main gold derivative through which people enact trade, it's the gold price that will be so volatile. Silver, yes, is still money. It is a monetary asset, but because of the 1873 crime against silver, when the dollar shifted from a bimetallic silver and gold standard, which was not perfect in itself, to an exclusively gold standard, monetary demand for silver has been masked and continues to be masked. So silver will be less volatile through these tariff wars and these waves in the ocean. Gold will be more volatile because it is explicitly the base of the dollar, whereas silver, since 1873, is not on a legal basis. But what I really wanted to say in this video is that the volatility in gold right now is not showing up in the gold futures market. Is the lack of activity in the futures market and the fact that open interest, the amount of contracts open, gold contracts specifically, open on the COMEX, despite yesterday's triple-digit plunge in the gold price, open interest actually went up. And this has only happened twice in the history of gold trading, at least as so far as Grok is concerned. I couldn't find the data raw, but I did ask Grok the question and it gave me a decent estimate of the information that I was looking for. I'll share you that table in the slides coming up.
What do you think of Rafi Farber's take? Do you agree with his bearish view on gold? Are you buying this dip? Post in the comments section down below your honest opinion and share with the stackers if you're buying more, selling, or getting active in the numismatics world. Let us know. We really want to know. Now watch this video right here because it's a perfect fit for you, and I'll see you on the other side.